Okay, let's dive straight into this explainer. You know, if you've been watching the markets lately, finding a stock that combines explosive momentum with a genuinely puzzling valuation, well, it's pretty rare. So today, we're unpacking the hard numbers behind BGC Group to figure out what's really driving their stock. Here's our agenda for today. We're going to filter these numbers through a four-step funnel, starting with explosive market performance, moving into revenue and profit margins, checking out their debt and dividend returns, and finally diving deep into a bizarre valuation mystery. All right, we absolutely have to kick things off with this massive number, a 178.70% total return over the last 3 years. I mean, that figure instantly demands your attention, right? In a market where a steady 10% annual return is usually a high five moment, nearly tripling an investment over a 36-month period is a huge indicator of shifting market sentiment. But as you might guess, a number this big rarely comes without a pretty wild backstory. Section 1. Explosive market performance. Let's visualize that momentum. Talk about a roller coaster ride. Back in 2020, the stock took a tough 30% hit, then an 18% dip in 2022. But then the script just completely flipped. 2023 saw an absolute explosion, surging over 93%. And that incredible momentum has carried straight through 2024 and year to date. This is a massive, massive turnaround story. So right now, BGC is sitting comfortably at an $11.29 share price, boasting a hefty $5.6 billion market cap. They're actually hovering just about 5% below their 52-week high, which shows some serious sustained strength. We can clearly see the momentum on the surface, but what's actually fueling it? To figure that out, we need to follow the money flowing through the business. Which brings us to Section 2, revenue and profit margins. Let's look under the hood. Over the trailing 12 months, BGC pulled in just over $2 billion in revenue. With a compound annual growth rate of over 20%, I mean, they are moving serious capital. But as any seasoned investor will tell you, it's not what you make, it's what you keep. And here is where things get super fascinating. BGC boasts a near-perfect 98.4% gross profit margin. That means delivering their core service basically costs them next to nothing. But by the time we reach the bottom line, that net profit margin shrinks down to a paper-thin 1.19%. This huge gap tells us that extreme overhead or administrative costs are essentially eating almost every single penny of that gross profit before it ever hits the bank. But wait, despite that tiny net margin, the recent growth is literally off the charts. Net income jumped nearly 75%, and earnings per share skyrocketed by an absurd 777%. You see, when your profit margins are paper-thin to begin with, even a tiny increase in actual cash creates a massive breakneck percentage jump in earnings. And that rapid acceleration is exactly what's lighting a fire under the stock price right now. All right, Section 3, debt and dividend returns. Let's see how they reward their shareholders. Doing a quick liquidity check here, a current ratio of 1.21 means they've got plenty of short-term assets to keep the lights on. And when you pair that with a moderate debt-to-equity ratio of 1.34, BGC is showing a really balanced approach to leverage. Basically, they're using debt to fuel their growth without betting the whole farm. So how does all this translate to shareholder payouts? Well, the starting dividend yield is definitely on the modest side at 0.71%. But, and this is a big but, they've aggressively grown this dividend by over 26% annually over the last 3 years, marking 2 consecutive years of yearly increases. They aren't trying to lure you in with a massive upfront yield. Instead, they're offering a rapidly compounding payout that really rewards long-term holding. And that leads us right into Section 4, the valuation mystery. Let's find the fair price. Right out of the gate, we hit a bizarre data point, what we're calling the zero anomaly. Usually, we'd rely on baseline metrics like price to earnings or price to sales, but here, they are all sitting at a fat zero in the data. But if you look past that historical noise to the forward PE, it sits at an incredibly low 5.94, meaning, based on future expectations, this stock might actually be sitting right in the bargain bin. To cut through the noise of those missing current ratios and figure out the true value of the stock, we have to lean on the discounted cash flow, or DCF model. Just as a quick refresher, DCF is a valuation method that estimates the absolute fair value of an investment based purely on the cash it's expected to generate in the future. It completely bypasses market hype and just looks at the cold, hard cash. And this brings us to the ultimate puzzle,
Valuing the company based on free cash flow gives us a fair price of $11.68. So at today's price, it's slightly undervalued, with a positive margin of safety, which is basically your built-in cushion against overpaying. But if you run the exact same model using earnings per share instead of free cash flow, it spits out a fair value of just 74 cents. That creates a terrifying negative 1,430% margin of safety. It is a complete split personality in the data.
So we're left with a massive question for you. We have a company that nearly tripled in value over 3 years, generates $2 billion in revenue on razor-thin margins, and has a valuation model that simultaneously calls it a bargain and massively overvalued. Looking at this crazy collision of data, has BGC Group hit its absolute peak? Or is this explosive momentum just getting started? Dive into the numbers and decide for yourself. Thanks for joining me on this explainer, and I'll catch you on the next one.